You found the perfect house. The yard is pristine, the neighborhood is quiet, and you are ready to sign the papers. But the moment you hand over the keys, that picture-perfect dream often fractures. Most buyers spend years saving up a 20% down payment. Once that money hits the bank account, it feels like the financial finish line has been crossed. The heavy lifting is done. But looking at this side-by-side ledger reveals a different story. Alongside that standard advertised down payment, there is a secondary, invisible column. We call it the shadow ledger. It is a hidden avalanche of expenses permanently attached to every property. Failing to account for these off-balance sheet expenses is exactly why buyers routinely watch their savings drain to zero or see their financing fail right at the closing table. The paperwork phase to finalize your purchase is usually treated as an administrative formality. In reality, closing the deal is a massive, immediate drain on your available cash. This diagram shows how closing costs strike your wallet. By multiplying your purchase price by roughly 2 to 5%, you get your first major entry into the shadow ledger. These percentages pay for loan origination fees to process the mortgage, title insurance to guarantee you own the property, and escrow services to handle the transfer of funds. In booming markets, that combination easily extracts an additional $7,000 to $20,000 straight out of your pocket. Next comes the inspection. A standard general inspection runs about $400 to $600, but that report often uncovers immediate mandatory repairs that sellers refuse to negotiate, leaving you to inherit the structural problems. Take a look at older developments like these. Homes built before 1990 frequently hide decaying plumbing systems and frayed electrical wiring behind their walls. Finding most faults requires specialty inspections for mold, termites, and sewer lines. The closing table and the inspection period are heavily regulated checkpoints, but they also act as the first guaranteed financial strikes against your bank account. High-growth markets pull in buyers nationwide looking for sun and waterfront views, but living in a high-demand area comes with recurring financial traps. Florida famously has no state income tax. However, local governments make up for that through property taxes. When a house is sold, its assessed value often aggressively readjusts to match the current booming market, creating an instant spike in your annual tax bill. Then you have to factor in the geography itself. If you live near the coast, the weather forces strict mandatory insurance requirements. This photograph shows the reality of coastal weather destruction. Hurricanes and severe flooding are persistent threats, requiring specialized coverage well beyond a standard homeowner's policy. Looking at the shadow ledger chart again, we see the impact. Combining your homeowner's coverage with mandatory flood insurance adds an ongoing penalty that easily exceeds $3,000 every single year. Unlike a one-time closing fee, these climate and tax liabilities never go away. They are volatile, permanent hazards that will continually attack your monthly budget. Even after you move in, the neighborhood itself can drain your resources. Many tightly packed communities are governed by homeowners associations, or HOAs. These associations mandate monthly or quarterly fees ranging from $100 to $700. If the community needs a major repair, like a new shared roof, they can hit you with a sudden special assessment, adding thousands more to your baseline mortgage. Finally, there is the psychological trap of new home fever. Between activating utility deposits, hiring rental trucks, and buying new furniture to fill empty rooms, buyers easily burn through another $3,000 to $10,000 in year one. This final chart shows the math. When you stack these figures against the initial down payment, the shadow ledger often represents an additional 20 to 30% of the home's total value in cash requirements. Navigating these costs is the reality of entering a market like Tampa. While the consistent demand and rising property values offer a path to building equity, wealth only materializes if you can survive the first 3 years of ownership. The difference between a financial nightmare and a successful investment is having an expert illuminate this shadow ledger before you make an offer. By calculating these expenses, you can plan your budget, negotiate with sellers, and protect your investment.